we can start the session.
Happy morning, everyone. I've been given the topic on revenue neutral transactions. So I'll just run through the concept of revenue neutrality. So the revenue neutrality is not defined under any of the law, and it is not prescribed under any taxation statute. So, but overall, when we look at, it means that there should not be any change in the revenue to the government's kitty, or the tax proposal should either increase or decrease the revenues when compared to the existing probable collections or existing law when a new law is introduced. The doctrine, which is framed through evolved jurisprudence and internationally accepted guidelines. So this we will also understand how the taxation has been framed in India, as well as how the other jurisprudence or internationally accepted guidelines have been given. We'll just have a look at that as well. Important, and it's also revenue neutrality is important and a key tool for the development. So when we look at the taxation law, there has to be uh, a transaction where there is no extra or excess burden on the business as such because of these taxes. It has to be looked at, and taking that view. So we just try to understand. See, when a simple example I'll just take, there was an output tax of about 3,60,000 and the input tax is 1,20,000. There was a net outflow of 2,40,000. Assuming there was an RCM transaction where there was a GTA applicability of 10 lakhs at the rate of 5%, assuming credit is fully available, the output tax is 3,60,000 and we need to add the reverse charge mechanism tax at 50,000. So totally I'll be eligible for about 4,10,000 less input tax credit, which is 1,20,000 plus 50,170. The net outflow would have been 2,40,000. So when we look at this concept, this gives us an indication as to what is the aspect is overall the taxation or the tax structure is giving the government from the business amount of about 2,40,000 as tax. So this is one of the examples. We'll just in our deliberation, we'll also look at other scenarios as well. So the concept of neutrality, it is generally used. It has been used in the past to defend assessees consequences with regard to contravention which is being made. And we have also, it is observed that the courts, tribunals, and authorities, a couple of them have accepted the contention and a couple of them have denied the contention. So generally, it's the concept of concept which flows from the principles of equality and avoidance of double taxation. This is the main principle which we will be looking at. So there should be a no loss of revenue to the government and due to the act of the assessee. And we also can look at the aspect of bona fide belief, which the aspect where it is missed out because of some tax discharge has been missed out because of bona fide belief, probably. And the first, I would like to take you through the OECD International VAT or GST guidelines, which tells that the guidelines on neutrality. So there is a guideline, and these guidelines which have been approved on 28/6/2011, it has come into force. Then when we look at the OECD guidelines, it tells that the VAT generally has a couple of concepts or the characteristics or principles we can call it as. One is it's on neutrality, efficiency, certainty and simplicity, effectiveness and fairness and flexibility. Out of that, if you look at the first one itself is neutrality. It talks about neutrality, which is the main characteristics, and it tells that the full right to deduct input tax credit to the supply chain. So what do you mean by this full right to input tax credit deduction is it means that the business should not bear any burden of taxes except where it is specifically which has been mentioned under the law specifically. It ensures the neutrality of tax. Then VAT, when we also look at the international trade, it could mean that it is normally a destination-based tax, and this means that the exports are free, whereas the imports are going to be taxed under the international trade. So what should also be administered in a neutral way? It should be that the businesses should not bear any disproportionate or inappropriate compliance costs that could distort the economic decisions. So there should not be any discrimination between a foreign foreign body or a domestic company or a foreign entity and a domestic entity. So there should not be any differences what the way the VAT has to be administered is what has been brought out in these particular guidelines. This guidelines has around 6 principles, 6 guidelines where it tells that the burden of VAT should lie on the taxation of the business only, and it should not be explicit unless it is explicitly provided. So generally what happens, the final customer has to bear the VAT. The burden of VAT or the burden of GST is what the first guideline tells. And the business is only a pass-through entity. So the business should not bear the impact of taxes as such. So there could be an exceptions to this when we take, for example, we have a lot of exemptions. It could be services to the government, or it could be hospital services, or a couple of things where it's a turnkey projects and which have been given to the government. As such, probably those sort of services could be exempted, or a sale of a couple of products are going to be exempted. So the second guideline tells that the business in a similar situation has to be taxed at similar levels of taxation. That is, the tax should be neutral and equitable in all similar situations. The guideline number 3 tells that the VAT should not be the primary influencer of the business decisions. So here, in addition to the support of the neutrality principle, the VAT rules have to be accessible. Then it has to be clear and consistent is what the guideline number 3 mentions. Then when we look at the fourth one, it talks about foreign businesses should not be in a disadvantageous or an advantageous position, is what this particular point is. And it also tries to give that the VAT principle should be neutral and equitable. That is what equitable. That is what this particular guideline tries to ensure. Guideline number 6, it ensures the foreign businesses do not incur irrevocable VAT. So the governments need to choose the approaches based on this particular aspect as well. Then guideline number 6, it talks about the foreign businesses which are deemed should not create disproportionate or inappropriate compliance with regard to the burden for the businesses as such. So they are telling that there has to be a level playing field between the foreign businesses and the domestic businesses as such. Overall, when we look at the 0.456 all put together. Then I come into the history of history till wherever I could have reached, have taken the concept of revenue neutrality in India, how it took shape. And when I looked at the previous things, we saw one of the aspect with respect to 1999 in one of the case of BPL Sanyo Utilities and Appliances, where the goods were removed from a manufacturing entity to one of the branches. So under the erstwhile excise law, as soon as the goods have been removed from the manufacturing entity, we are supposed to discharge the taxes. So there appeared to be some amount of valuation issue when the goods have been removed. But however, the other branch where the goods have been removed, there the taxes have been paid from the PLA account, basically, or it tells that the taxes have been duly discharged from the branches as such. So even because it was under the same entity as such, similar to our distinct entities, whatever concept we have today. So the goods have been removed from the manufacturing entity, and it is then it has been transferred to the branch or the other location, and from there the goods have been again sold further. So overall, in this transaction, they tell that this transaction was, even though there is a loss of revenue to the government at the stage of the removal at the manufacturing entity, the same would have been allowed as a credit because the amount was already paid through a PLA account. So when we look at this particular aspect, it tells that there is a revenue neutrality as such in this regard. So when the entire amount of tax, whatever is paid by the manufacturing entity, is given as a credit in this particular other entity, which is going to sell the goods. So when we look at this aspect, so the revenue neutrality was examined, and they have told that it is more of a revenue neutral transaction and there is no intent to evade duty. So the larger period of limitation was not sustainable is what the decision in this PPL Sanyo Utilities case was initiated. This was as early as 98-99. Then we had one circular, board circular in 2009, which talks about what is the aspect when the goods were returned or rejected, and it has been received in the factory before the prescribed date for due payment can be allowed. So here it told that under Rule 16(1), the credit can be allowed as the transaction, the whole procedure becomes a revenue neutral transaction is what has been initiated under the law itself. So when you look at many of the places, even under the GST law, there are a couple of aspects which have been, the law has been amended after the introduction as well, where there is a aspect which they have been given a clarity so that there is an aspect which is they bring about an aspect with regard to double taxation avoidance, and because of which to avoid double taxation, they have introduced a couple of what you call circulars, or the law has been amended basically. So to understand the concept of revenue neutrality under the erstwhile law, we'll just understand a couple of transactions or the case laws to understand where or how it was accepted and how it was denied. So I'll just take a couple of cases where it was accepted earlier on the aspect of revenue neutrality. So in this case called V Commercial Vehicles versus C, it was a tribunal decision. Then later on it was affirmed by the Supreme Court as well. The facts, when we look at, the company exported chassis fitted with engines. So it had exported and the excise duty was paid at 10% under rebate scheme. Whereas the excise duty applicable was 10% plus specific excise duty at 10,000 rupees per chassis, which was supposed to be discharged. The departmental stand, what was told by the department is the differential duty is payable along with interest and penalty, technically. So, but the assessee has contended that this differential duty, if paid, will also be refundable to them in as much as the goods which have been exported. So this was the stand which was taken by the assessee, and the outcome of this particular case, if differential duty is paid, then they shall be allowed as a rebate since goods are exported, and it gives and the court has agreed to the contention of the appellate, and it has given that the entire transaction becomes revenue neutral and the demand was set aside in this particular case. So the next case is Mahindra and Mahindra versus CC, where it was mentioned that clearance to own units. So similar to the BPL Sanyo which was there, here also the goods have been cleared to the own units in Nasik and Zirabad. So where the assessable value was arrived at cost plus construction method. Whereas the department has contended that the assessable value was not correctly determined with regard to the administration expenses, R&D expenses, and the royalty of the head office was not being considered for the removal at the time of removal or the costing as such, and they demanded a differential duty which has been raised. So, however, even in this particular scenario, when we look at it, it wasn't similar to that BPL Sanyo. So there is no dispute that the recipients, the units are of the recipient's own units. So the recipient units have paid this amount of around 75 and 16 crores under the PLA respectively. So any differential duty paid, the same was available as a SENVAT credit in the recipient's account units. The entire exercise of payment of duty and availment of credit is revenue neutral, and the duty demand is not sustainable. So this is what the court had taken at that point of time, the decision. And the next one is with regard to Jet Airways, where if you look at, they have availed the services of a computer reservation system, which was from outside India. So they had not the ambit, it falls under the online database and retrieval service. This is what was the department contention, and they told that service tax is payable on reverse charge mechanism on such service. So the assist contention was, it was revenue neutral because whatever taxes I pay as under reverse charge, I was eligible to take that as a credit. Then the outcome, it was observed that service tax payable under reverse charge mechanism being available as credit for discharging tax on its output service. So the entire issue was treated to be revenue neutral, and demand, interest and penalty was not sustainable. So this is what was the overall transaction. Then the next one with regard to the Coca-Cola, this was in 2007, where the facts is there was concentration of these beverages, whatever was there, or the concentrates were manufactured by the associate, that is Coca-Cola, and it was supplied to the bottlers, and that was given as a raw material for the bottlers, and again the finished food would come back to Coca-Cola. So the department's contention is that the dispute relates to the classification of the beverage. Maybe there was a higher rate of tax which was payable, and there was an additional demand of duty which was payable. So the assist contention was, it was anyway, it was treated as modvatable, and the other company or the bottler could have taken the credit of it, and again it would get passed on to the assessee per se. The Supreme Court accepted the stand of the assessee and told that since the duty payable by the respondent is modvatable, there is no revenue implication. So the aspect what has to be kept is, when we look at these particular scenarios, there should be an aspect that there should be revenue neutral, is whatever is the total amount of credit which is available, the entire amount should be available as a credit as well. Whatever duty has been discharged or should have been discharged, the same amount should be available as a credit as well. So when we look at this aspect, this is one point which has to be kept in mind. Then there was a case of Narmada Chemicals case where, Narmada Chemitur case, a pharmaceutical case, where the assessee was manufacturing, it had claimed an exemption. It should have claimed an exemption, but there was a conditional exemption. But however, the department, it had not claimed the conditional exemption, even though it was available, and the appellate chose that their final product, they would discharge the duty, whatever was supposed to be done, and it had availed all the input credit on input. So the department's contention was, even though the final product, they were treating that the final product was exempted, even though they had cleared it with payment of the, they were not eligible for entitled for availment of modvat credit. So here, in this particular case, the Supreme Court held that there was an optional exemption, which was there, and they have enabled availment. And in such a case, when the credit or modvat amount claimed to be wrongly availed is exactly equivalent to the amount of excise duty paid by not availing certain exemptions, the consequence becomes revenue neutral, because here I would have lost the input tax credit and I have not discharged, where in the other manner, when we are looking at, so there could be treated as a transaction of revenue neutrality. Hence, they told that the demand availment was rightly quashed by the tribunal. That is what the Supreme Court told. Then there is another case which was J. Yushin Limited, where it was held that the manufacturer had received certain inputs free of cost from the supplier. However, they had not considered this extra consideration received from the supplier for components. So department allegation was the valuation was not properly done, and the cost of this free components was not added in the final product of the final product for duty discharging. So the RCC mentioned that the availability of modified credit when duty is paid were set off as a Sinvat credit to the assessee. So the query before the Supreme Court was whether the extended period of limitation under proviso would be applicable to such cases. So here the Supreme Court has mentioned that where the extended period of limitation was held in invalid due to the revenue neutrality is what it was told. But there was two aspects or two concepts which was being observed, which is very important, which I think we need to have it on record. So the revenue neutrality began being a question of fact. The same is to be established in the facts of each case and not merely showcasing or showing the availability of an alternate scheme. Just because there's an alternate scheme, so whatever has to be looked at from case to case basis has to be verified. So with regard to specific reference to the modified scheme, it is shown that the revenue neutral situation comes about in relation to the Sinvat credit to the assessee himself and not by way of credit to the buyer of the assessee's manufactured goods. So here in this particular, they have brought out the second point, which is very relevant because this may have an impact even under the under the aspect when we look at the GST aspect. So this aspect is the one which has to be kept in mind, and this could become aspect for which transactions could go against us also. So this aspect, when we look at this aspect, when we look at case-to-case basis, here in the Gemcon Industries in 2008, which is a Mumbai tribunal, it was affirmed by the Supreme Court. Here free samples were given. However, it was held that value of these free samples, which was supplied by the buyer to the seller, is required to be added to the assessable value, which forms part of the additional consideration. So there was an additional consideration for the they had assumed that there is the department's contention is there is an additional flow of consideration. So the assist contention was it was a revenue neutral situation whether this particular would be this particular amount of taxation would be available as an input tax credit. So the department told in this particular thing there was two aspects which had to be looked at. The court has observed that when we look at this aspect, the Senvat credit was not taken by the appellant. Rather, it would have not been available, whereas the credit was admittedly taken by the buyer and not the appellant. So here it appears that in this particular scenario, there are three people. One is the supplier, one is the Gemcon, and there is another customer. So the goods were directly billed to the buyer, which the buyer would not probably have taken or he has taken the credit directly. So when we look at this particular transaction and they also in this particular case, there is the appellant once this particular turnover would be considered for the purpose of valuation would cross 1 crore and they would be required to pay duties on the other taxes, other goods which have been claimed as an exemption as well. So therefore, here they tell that there is the concept of revenue neutrality does not apply in the case in the facts of the present case. That is what is the aspect which has been looked into. Then there is an aspect of melange developers. So in this melange developers, it's a works contract case, and this particular transaction as a main contractor is exempted. So whoever is the main contractor, he has provided certain transaction and which is exempted from the tax. So there, in this particular case, a melange developers is the subcontractor, and he has try to take this amount exemption. He also has taken the exemption and he has told that it's not liable. But however, in this particular case, they have clearly told that when there is a specific, when there is no specific exemption which is given to the subcontractor as such, then the transaction becomes taxable and the subcontractor is liable to discharge tax. So just because there is a credit which is available and the other person is because there is a exemption which is available for the other person, it does not mean that there has to be exemption even for this particular subcontractor as such. And here they told that it was clearly brought out in the outcome of the case law that the subcontractor has to discharge the service tax liability when he renders a taxable service. So that is what is the aspect which has to be kept in mind. Then we look at doctrine of revenue neutrality. What is the difference between a couple of the cases which have been taken up, and how it has been distinguished in a couple of cases, that is Larry Impex and the Northern Operating System. So there it was mentioned in Larry Impex that there were favorable decision with the Coca-Cola case, which has been distinguished in this particular case, and this Larry Impex basically it was a non-fulfillment of condition of duty drawback, and it was held that merely just because the assessee could claim the duty drawback on a later date does not mean that there is a revenue neutrality as such. And they tell that there is a specific purpose with which there was a 1 year time frame which has been given under the notification, and that also has to be given importance. So it is not that only revenue neutrality has to be given importance. So you have to give importance to why there is an exception which is given. And when we look at the OECD guidelines also, they also have brought out the guideline number 1 has very clearly told that whenever there's an exception, then that exception will prevail, and the neutrality need not stand what as it appears to be when we're reading that case, this case as along with the OECD guidelines as well. Then the other aspect is with regard to the Northern Operating System, where in para number 59, it is very clearly told as regards the question of revenue neutrality is concerned, the assessee's principal contention was that it is assuming it is liable. On the reverse charge basis, nevertheless, it would be entitled for a refund. It is noticeable that the two orders, that is SRF and Coca-Cola by this court, merely affirm the rulings of the SESTAT without an independent reasoning that presidential value is of a limited nature. So they try to tell that these particular aspects which have been discussed does not have a presidential value, and it has to be looked at only in a limited nature. So because it has been examined without the independent reasoning. So this court has been in the present case called upon to adjudicate about the nature of the transactions and whether the incidence of service tax arises by virtue of the provisions of secondment of service. In that a particular rate of tax or no tax is payable, or if and when liability arises, the assessee can, through a certain existing arrangement, claim the whole or party of the part of the duty as refund is an irrelevant detail. So this is what they are trying to tell. So whatever had been discussed under the earlier revenue neutrality, here the entire concept has been reversed. When we look at, there is no importance which has been given to this, and it gets into the aspect of the law which is being important, and based on which when we look at, so now we will have to see how to utilize this particular doctrine of revenue neutrality. So when we come to the doctrine of revenue neutrality, when it comes to the income tax, so I'll just I think there are this revenue neutrality has been used in a couple of even other laws also, and income tax being one of the a couple of old decisions which are also there here as well. So under the revenue neutrality, the courts accept a revenue neutral situation when the assessee has been following. This could be a real estate project where they were following project completion method instead of percentage completion year on year. So when we look at it, is only the timing difference, and because of this timing difference, they tell that this revenue neutrality situation is allowed, and they have told that there is no loss of revenue to the government or the department, and it's allowed. So similarly, when we look at the assessees change with their accounting method, so including stock valuation as per 145, probably they have been adding the customs duty for both purchase value and closing stock. So this is because the amount is debited and credited to the trading account, balancing out that there is no impact on the taxable income. So this is the when it comes to the income tax, one of the cases. Then similarly, when there is a interest on capital which is allowed under section 40B in the hands of the partners, again it cannot be taxed in the hands of the firm. So that is what is the concept here. They have brought about a revenue neutrality because there cannot be a double taxation is what I think they have tried to come out in one of the case laws. So then the concept 3 is where TDS was supposed to be deducted by a company or an individual enterprise, but they have not deducted the tax. But the deductee has filed his income tax returns and has already paid the taxes which is relevant, and that proof is sufficient to prove that there is no liability on the part of the deductee. No, even though there was a liability, as the tax has already been deposited with the government, so that means that it becomes a revenue neutral transaction is what the stand was accepted, and a couple of decisions are there under the income tax even on this particular concept. See, when we look at the scenarios of this, whatever we could try to understand, I could envisage that there are three types of cases which can be dealt at. One, where the assessee, only the assessee is involved when it comes to the taxation or the taxation aspect when we are looking at the revenue neutrality. And in the other case, there could be a supplier and an assessee, and both put together there is a revenue neutral transaction. Or when it is an assessee and the customer, both put together, it could be a transaction which is getting where the transaction becomes revenue neutral. So when we look at these aspects, it is barging around, it is coming to a situation where it is when it is the aspect of revenue neutrality is more or less considering the previous regimes. So it tells more with respect to the assessee, and where it has done an error, where it would not have given lot of aspect where there is loss of revenue. There is no loss of revenue to the government. This is what is the aspect which is trying to get into. So this I am trying to look at when it comes to the assessee. So it could be something like reverse charge, not RCM is not discharged. Maybe it's import where it's 9.3 or 9.4. So the assessee is mainly on the impact is mainly on the assessee when we look at in the assessee per se. But when there is a supplier involved, for example, it's a GTA. GTA service, what happens? It's my responsibility in that particular scenario. But however, the supplier also, the GTA provider, the service provider also has paid taxes is one of the scenario which we could look at. So there could be a possibility of double taxation. Then there could be a supplier and an assessee. It could be there's a principal manufacturer. There could be a job worker situation where the goods have been removed for job work, and again it is coming back to the principal is one of the aspects which we have seen. So supply to a sister concern. Also, a couple of the case laws where we have seen that supply to a sister concern. I think sister concern means where they are under probably the same group entity, or it could be under the treated as a distinct person, probably is one aspect we have to look at, where the impact is going to be the tax, interest and penalty. So if there is a assessee and a customer, and there is a wrongly claimed exemption on the assessee, then the impact would be not revenue neutral, because the taxation, whatever would have come, the customer might have been able to take the credit or not. This also plays a vital role. So there could be one impact on this particular transaction where the assessee has to pay the taxes. Probably this could be one of the scenario. So we will look at the aspect of the double taxation versus revenue neutrality. So double taxation or revenue neutrality, when you look at, so double taxation on the same aspect, there could be a taxation which is going to be twice, one in the hands of the supplier and other in the hands of the recipient. That could be one of the scenario. When it comes to revenue neutrality, generally it is a zero impact, that the assessee can plead or take a aspect that is similar to our RCM, where the tax whatever is been paid will generally be allowed as a credit. But when we look at this aspect here, there are many scenarios which we need to understand, which we will just look at when even a reverse charge mechanism, the taxes are paid, the entire credit may not be available always. So that also has to be kept in mind. So this is where I was talking about a couple of notifications under the GST also, which have been given, where to avoid the aspect of double taxation, this is with regard to location and place of supply. When we look at this aspect, so there have been a number of notifications, and the government itself is trying to give a relaxation that there should not be a double taxation or non-taxation for a supply of services. So this is what is the overall thing what we are trying to look at. Even under the GST, the government is trying to give relaxation when it comes to a double taxation. So similarly, I think over a period of time, the law could frame and we could see there could be changes even under the GST law as well. So doctrine of revenue neutrality when it comes to the forward charge. So based on time of supply, which is not being followed, interference with revenue neutrality, there could be a time lag between when the time of supply is not being followed. So the taxation has not got taxed for a particular transaction, maybe based on a milestone which has been achieved. The transaction should have got taxed. But the other person has, when we look at this timing difference, there could not be a revenue neutrality because milestone billing versus the actual billing, there could be a difference as such. So in these cases, how do we handle the scenario? Then in case of revenue, in case of a reverse charge transaction, there is a revenue neutrality. Generally, whenever the month in which we discharge the reverse charge liability, we take the same month the credit has been taken. So there is this, we could take the aspect of revenue neutrality here. So when we look at the GST is again a destination-based tax, and the principles of revenue neutrality is that the burden of tax should be borne by the final customer, and such taxes should not constitute the business entity, the business entity or the supplier's cost. So that is what is the aspect which we could try to impress upon the department at all stages. So if such intention is not maintained, then seamless flow of credit, which is intent of the government, would be disrupted. Just because of procedural lapses, there should not be the transaction should not lead to a burden on the business is what we can try to impress upon. So when we look at the reverse charge mechanism and the impact of revenue neutrality, I could categorize this into two buckets. One bucket is where there is no impact. That is when I have paid or discharged a aspect of tax on revenue, RCM have discharged. There I will be eligible to take the full credit. Actually, in one scenario, I'm eligible to take full credit. In the other bucket, we see that there are going to be situations where the credit is not allowed in full. For example, in composition dealers, even though I'm liable for all my reverse charge mechanism, it could be, for example, hotels, when they have taken something on some residential properties on rent, then they are supposed to pay taxes on reverse charge mechanism basis, or wherever there is a reverse charge mechanism is eligible. And in case of regular scheme by hoteliers, because hoteliers or restaurants are not eligible to take the input tax credit if they are discharging tax at the rate of 5%. So when we look at these particular aspects, or if it is a real estate transaction where it is considered as a REP or RREP. So depending on that, if we have gone for that, the lower rate of deduction, lower rate of tax, which is at the rate of 7.5% or net, when we take the net value of 5%, where input tax credit is not allowed, where transactions, where the ITC, we should have satisfied the condition of 80% in this real estate transactions, where if we have followed this particular scheme, availed the scheme, then there should be purchases of 80%. Then here also aspect of revenue neutrality cannot be taken forward. So I think this is one of the aspect which I could try to give my thoughts on. So when we look at, see, there are these cases, when we look at the cases, so this particular cases, there could be a revenue neutrality. I have just divided into two buckets here. So depending on where the credits are fully eligible, then probably we could take this particular aspect. And here I have try to take where if it's a reverse charge mechanism, then there is a possible stand we could take. See, this accepting the stand by the department or not, that is very, I think it is again the decision of the courts at the relevant point of time. And I think this is this is going to lead to an aspect which we need to think about. So the first one is demand under reverse charge mechanism for import of services. So here we could take an aspect of revenue neutrality, but considering the point of northern operating systems, we'll have to, this is going to test waters. So then you have the input tax credit of CGST and SGST claimed as IGST or vice versa. Here also it could be claimed as a procedural lapse because it just because we have put something under a wrong column is one stand what we can try to take. Then reverse charge paid as IGST instead of C plus S. So here also, even though there is, but here the only aspect what I think I have a issue here is when it comes, the department may consider this IGST and CGST, SGST. When we look at this particular thing, there are three different acts. And can we take the stand of revenue neutrality? So this is an aspect which has to get tested. The testing of waters has to happen because the under our earlier discussions and earlier forums, when we have seen that when there is a liability under C plus S and however I have discharged it under IGST. So even I think there's a circular which tells that I'm not sure whether the circular here with respect to C&S. C&S, if I have, I should pay the C&S and here I should go for IGST refund. That is what is the aspect. But can we take this stand? It has to test waters and we'll have to look at and examine. So time of supply is not followed as per the timeline, but already invoiced at a later point of time. So when we look at that and the taxes have already got duly discharged, I think nowadays we are seeing that in the assessment orders, be it under the center or the state, there wherever the taxes has been duly discharged, they are asking us to remit only the interest if the time of supply is at a different state. So different time is considered. So only the interest is being liable as such. Then the next one is credit note being shown as outward tax and not reversed as ITC. So here also I think it could be taken more on a procedural ground because the books of accounts, if they have already been accounted and it has already been reflected in the 3B, then in this particular case, I think we can take a stand that it is a revenue neutral transaction and it is more of a procedural aspect and a bona fide belief. All these aspects have to be considered. Then misclassification, but there is no additional tax payable. So in case of misclassification, there cannot be an additional taxes. So both are say 18% only, but it has fallen under two different HSNs. Then there's a possibility which is to be looked at. Then valuation with respect to between distinct persons having the same PAN or related entities. So when we look at this aspect, considering the earlier excise case laws which have come in our favor, so probably we can look at in case of a distinct entity, overall it would be under the same PAN and they should not change the scenario is one possibility what we can look into. So the next aspect is with regard to the where revenue neutrality may not stand or there could be an aspect where it could not stand waters. So one is misclassification of goods or services resulting in short payment of taxes. So this aspect can be not generally when we look at if there is a higher rate of tax which is payable for instead of 1828 becomes taxable, but the other person whether he was eligible is one aspect which we could consider, but nevertheless as there are two people involved. So here one aspect is which could be a aspect which could be a thought which needs to be, and all these cases have to be we need to look at how and what the aspect has to be examined as such. Then excess RCM paid and ITC has been taken. So here also when RCM is paid, then we have only taken in a couple of cases that RCM paid in excess is not at all a tax. Any amount which is paid in excess is not a tax and we can go for a refund and that can be looked at. But if an ITC is taken, then are we assuming that this particular transaction is a tax? So that is what has to be examined, and here there could be an aspect which is going to have issue as such. Then demand for existing taxable value resulting in short payment. I think this we have already discussed. Then when ITC is claimed after the period allowed, that is the 16.4. So here the OECD guidelines is when we look at is going against us. But however, I think we have to look at the aspect of 16.4. 16.4 could be looked at where because there was a change in the date itself from 30th September to the returns filed before 30th November. So when we look at that, can we take an interpretation that this 30th November law itself has got replaced. So that is an aspect which we can relook and take a plea before the courts. And again, that has an aspect which is going to give us some thoughts. Arguing against the principle behind the restriction of ITC. Again, so as OECD guideline also has told that there could be a law which has given certain exceptions, and this could be one of the exception of restriction of ITC. Then each aspect which needs to be looked in. It could be in relation to immovable property, motor vehicle, etc. Is it allowed, not allowed? And this is again depending on the safari retreat case. So what is that we are trying to give? Is it the immovable property service or renting of immovable property service? And because of which immovable property has to come into existence. So that again, we are awaiting the Supreme Court decision, and based on which we could look at it. What could be the analysis here? So when we look at this aspect of revenue neutrality, so we see that the demand generally, what could be the plea we can take is demand will be the demand should render become unsustainable is one aspect. Then there should not be any interest and penalty for such thing if there is a bona fide belief, and the extended period of limitation should not be taken up, and the we can argue based on the double taxation, and these aspects can be kept in mind and we can take it forward is my view. When we on the conclusive front, I would like to state that there is no hard and fast rule for applicability of revenue neutrality. It has to be, as we looked at the different aspects about composition or regular where the entire credits are available or not. So each case has to be examined fact wise, and we need to look at what are the aspects, whether there is going to be an aspect where revenue neutrality is going to be given or not. First we need to examine the facts, and in the facts, if we have that the transaction is revenue neutral, because we need to work out, and those facts are going to help us in when we are filing the plea. Along with, there are a couple of things under the law also, considering the previous case laws which have under the erstwhile regime, as well as the advance rulings and other things which are going to be there, we need to try to use them, and we need to, because this is nothing but a concept, we have to test waters, because this concept has not been dealt with, and we can look at what needs to be taken up as such. So here in this, only the last point I would like to highlight, and the last point is, could it be used where a transaction get taxed as in both the countries or exempted in both the countries? Again, it depends on when there is a global cases, or more than one country cases are also involved. Probably we can look at this, keeping the OECD guidelines and other things as well. So that is what can be looked at and taken forward as such. So the next aspect, which, sorry. So I think as a conclusion, revenue neutrality should not be used at the planning stage of any transaction. And I feel that it should only be used as an aftermath, because the cases already got, the facts have already got envisaged, and based on which we will be taking the aspect, and this is more of a litigation and litigative view. I can tell the plea of revenue neutrality should be applied to all situations. It cannot be applied. That's what I wanted to tell here. Then they should not be argued for cases which abuse the procedure or malified intention is going to get involved. I think we shouldn't involve it there. Then it's not a right to claim benefits always, need to be applied judiciously and cautiously, only in exceptional cases. And the aspect where interesting arguments will, I think we have to wait and watch, because of the aspect of the couple of laws getting involved under the GST, because it's a dual levy and we have a single levy under IGST. So we are going to see how it is going to be looked into. So as this aspect, there are few issues which are getting raised by the department. One is reverse charge mechanism from 1717 to 131017 for assessments of 1718. Then you have purchase returns, returns which should have been reversed from input tax credit So probably which has been shown as output tax or vice versa when we look at. Then the sales returns taken as input tax credit, what would be the implication? So the other aspects are with regard to the CGST and SGST considered as IGST, it has been utilized. So what would be the impact? Then the reverse of IGST to be done only on the balance. See, for example, now I am supposed to pay certain, I have already utilized certain credits, but as on today, I have to reverse. But I have utilized at that point of time, I should have reversed. Now I should have reversed as a IGST, but I have balances in CGST and SGST. How should I do? So is it going to be a revenue neutral transaction? So according to me, recently in one of the case also when there was a transitional credit issue and we have reversed the credit, there was the credit was not utilized, but however it was shown only as a CGST and SGST. So IGST generally is being allowed by the authorities to be debited or reversed as a CGST. This is what I could. We had a discussion even with the department, and internally they have discussed, and they also suggested us to go for the reversal under the CGST only. For the IGST reversal, what had to be done. So thank you all for a patient hearing, and I thank all the mentors for choosing this topic for me. And I think this is a new concept. I have tried to give whatever could be possible. And now I would like to hear for any questions as well as any explanations in this regard.
Thank you, Shekhar. Jatin sir, your views?
Yes, sir. Shekhar, very thorough presentation.
Thank you, sir.
The content of the slides are cover the topic in sufficient detail, in good detail. I have maybe 2 or 3 points to share.
Yes, sir.
The conclusion slide destroyed the contents in the whole presentation. Was that deliberate? Basically, in the conclusion slide, revenue neutrality is basically unusable except when you're already got caught in a messed up situation is where revenue neutrality can be used, was the impression I gathered. Is that wrong or is that okay more or less?
Sir, why I took that
No, in the conclusion you tell me. Is the conclusion going against everything that we saw in the presentation up to this slide?
Okay, okay. So
okay.
this
So that's one point.
I added this point only in the morning. Yeah.
No, fair enough. So basically,
yeah,
you have undone in the conclusion slide everything that is done so far. That's point number 1. Point number 2, this OECD guideline, is it relevant in GST? Everyone keeps bringing OECD as if to say that anything that comes from Europe is somehow somehow that requires obedience by all third world countries. What is the relevance of OECD reference in the context of GST law? Why contaminate the discussion by throwing something Western?
Okay.
Into our domestic discussion.
Okay.
Third aspect, last aspect is, if ultimately everything is going to be revenue neutral, why multi-point tax system with ITC? We can go back to last point tax system where main contractor will pay, L&T will pay GST, cement, steel, labor contractor, machinery supplier, nobody should pay tax ultimately. So if you really consider the argument of revenue neutrality, whenever we advance, we are basically admitting that we have made a mistake. Isn't it?
Yes,
if we advance argument of revenue neutrality, we are basically conceding that we made a mistake. Now we are trying to patch it up by giving some logical argument, contaminating it with some European principle. Then, because if you see the earlier law in Narmada Kemfar, in that 179-80, 276. In fact, in 179-80, 20 also there is another decision on revenue neutrality. The concept of revenue neutrality in Circular 1053 was relevant only to examine whether extended period can be invoked or not. Because
Yes.
it is creditable tax, there is no motivation to evade this creditable tax. That is the limited purpose of revenue neutrality argument. In GST, if we say whenever there is a demand that there is a revenue neutral situation, so therefore the demand should not be raised, that means we are accepting the allegation made in the notice that yes, we are wrong. Yes, what we have paid is not the right tax, and the department has caught us, and we are now trying to wriggle out of a situation that we are clearly in the wrong. So my submission is only consider with great caution. If we use revenue neutrality as an argument, we have conceded defeat, and we are still just trying to save an otherwise hopeless situation. So please see if you want to, if you're comfortable with the conclusion, because the conclusion slide completely destroys the rest of the presentation.
Okay, sir. I'll just take this point, sir, and I will just reconsider the conclusion and I will again
All right.
share it.
Because the conclusions I'm in agreement with. You see
Okay,
the
sir.
conclusion slide, I'm in agreement with it, saying that you can't use it at the planning stage. It can at most be used in a court of law. You can try this argument, but don't give any guarantees. All these things are there. Just one point you can add is to say that examining on arguing on revenue neutrality means we are admitting wrongdoing.
So
That's
then in each of our replies, then first it should be more of, we should be arguing on the bona fide belief only, sir, in that particular.
no. See, if I have made a bona fide belief is only relevant for 73 or 74. If you're wrong, you're wrong.
Yes,
Bona
sir.
fide or bona fide. So bona fide does not excuse any liability. Bona fide only maybe excuses penalty under 74.
Okay, okay.
So be very careful. Bona fide does not make any wrong right.
Okay, yes, sir. Thank you, sir.
Thank you.
Rajesh sir, anything you would like to add?
Venu, nothing. I think Jatin sir made the points clear. In fact, when we were having discussion with Shekhar also, we were of this same understanding what Jatin sir was explaining. This can only be a, for a limitation more, because all the case laws drives towards the limitation point more than not to say that you need not pay tax.
Yes, sir. I think in the discussion, we had discussed the point, but only conclusion, I think I'll change it, sir. I think that was
No
the.
problem.
Okay. Sir,
Venu, I think in between you had raised one question about the double taxation thing. I think Shekhar can explain that. Shekhar.
What is the query, Venu?
No, I want to re-understand. You distinguish double taxation versus revenue neutral. Like I want to understand with example that, okay, like these demands, if it is of revenue neutral will not sustain, but double taxation there cannot be.
There could be a double taxation is what I was trying to bring about. See, because just because a GTA has paid taxes, which he was not supposed to have done, he has paid it, and even I am also paying it just because of that aspect. I think I can't take the revenue neutrality was the point what I wanted to bring about there.
So my question here, Shekhar, is again not litigation. Assuming all my questions, I have the time limit to correct. Now I'll take the example of security services. So the security services, he has paid the taxes under forward charge, while ideally I should have paid under reverse charge. Now, what do I suggest to the recipient? Should I say go ahead again, pay and take ITC, or the taxes to the state has been accrued, do nothing?
I think there again, see, I think this is not a new concept. It was already there even under our service tax regime also. Similarly, you can take the GTA service only. So initially what we told that because once somebody has paid something as a tax, then the credit is also going to be there as a tax as such. But it does not remove the responsibility of me. So I have to take, I have to also pay the taxes under the reverse charge mechanism is what we had taken a consensus earlier that I will take the credit of the GTA tax as well and whatever is being charged, and I also as an additional precaution discharge the tax additionally if it is within the time frame. If it is not within the time frame, then I tell that as the taxes has already been charged by the GTA, it was a forward charge transaction, but we will have to take. I think this is my view. Maybe the mentors can add here.
But even when it is in the within the time, my question is why do I need to pay under RCM again? Because the supplier has assumed his position that this is a levy which is payable under forward charge. I would choose not to pay under reverse charge.
But there have been earlier under the service tax regime also, we have received a couple of notices that RCM has not been paid, and we have given the same stand as whatever stand you have taken, the same stand only we took. And it is told that the taxation has been charged by the other person. So there was no requirement under reverse charges what we had taken a stand.
Okay.
I think, the one finer point on this double taxation is there's only one supplier, one service. Okay. So, but two people are asked to pay. One person has already paid, another person is again asked to pay, is a concept of double taxation, irrespective of the eligibility of a credit to the other person. Whereas in revenue neutrality, it is a more like a input tax. I am eligible to take credit and again I'm asked to pay. That is a concept, I think, can be a distinction which has been tried to make. Correct, Shekhar?
Sir.
Jatin sir, on the double taxation aspect, you can just throw some light.
The double taxation is perfectly valid and legal. There is no principle in any indirect tax law to say due to failure by assessee, double taxation cannot take place. There is no bar on this. So I was supposed to pay RCM. My liability remains until I discharge it.
Okay.
Has any got the money? Why are you disturbing me? All these arguments are all have no basis in the law.
Sir, similarly on the ground, the credit of CGST, SGST was taken as IGST and it got utilized. So do I need to reverse the CGST, IGST extra and again put it as the CGST, SGST in the next month?
Can you repeat that part, sir?
I have taken the CGST, SGST credit as IGST.
Okay.
The choice is do nothing or reverse IGST in the next month and take CGST, SGST correctly.
Okay, so what is your question?
My view is if the credit, I'm also again in the place where the time limit to correct is there. So credit to be availed has been taken, assuming even if I have to reverse the IGST credit say through DRC 03. While I am discharging through DRC 03, I would again utilize the credit balance which is otherwise there in CGST, SGST. And again, I'm taking the same thing. So technically, there is nothing which I am
there is no technically, there is nothing. Follow the law correctly. Full stop. That's all. See, if ultimately books of accounts are maintained to arrive at profit, why maintain so many ledger accounts? Let's put everything into one. All these things we cannot say. So we are in the name of following the law, we cannot rewrite the law. Okay, na? However logical we may argue, there should be a basis in the law to do whatever we have to do. I'll give an example. 25th month, I go for refund. I am eligible for refund. Should they give me the refund? Answer is no, because refund should be claimed within 24 months. Transition credit can be claimed through 3B. You can't claim. Some high courts gave a view. Why did they open the portal again? Because of policy decision. So we can't say ultimately this is what is happening. Then what happens? Every individual taxpayer will become parliament. He will decide what is right and wrong. That's not the concept of what is called a rule of law state. In a country where the law is supreme, no individual can be given this privilege to decide what should happen in the country. You are using it for the right reasons. Somebody else will use it for the wrong reasons. You know how many people don't pay income tax, saying that look at the roads in our city, what is the use of paying income tax? All these things, and professionals like us should not even toe this line of argument, saying ultimately what is going on, technically what is going on, logically what. If you say that, why Tuesday morning trouble ourselves like this?
Okay.
If you see para 74, 75 of Mafatlal's judgment, Supreme Court, 9 members, Supreme Court said parens patria, which means the state can do wrong things also, no problem. There is no unjust enrichment by the state. State can unjustly enrich itself, no problem. 9 members have said. Maybe we should read that. About the concept of parens patria.
Okay.
So therefore, we can't use all these technical arguments. These are logical arguments.
Sir, one basic academic question. When is something called as doctrine?
There is something called a doctrine.
Ah.
Something which has been in existence for time immemorial and has been accepted as a.
So does the doctrine of revenue neutrality exist?
There is no such thing. We have only invented in study circle doctrine of revenue neutrality.
Okay.
If you put doctrine in everything, doctrine of logic, doctrine of Venugopal.
Okay. Got it.
If you can trace it to some judgment where the courts have held that they have accepted this principle and show history, and it goes back to Roman law, sir. Corpus Juris Civilis. It goes back to those where these principles were laid down, that these principles were used to make laws. These principles were not resultant of laws. These principles were the building blocks of the ancient laws that we today have. We either have the civil law or we have the common law. So if there we can find something, I think we should read Maxwell on interpretation of statutes to understand the concept of history of laws.
Got it.
Right.
Got it, sir. Okay. Any other questions from anyone before we move to the next discussion?
I think this concept of revenue neutrality, I don't think it will get resolved at the adjudication level. I think it is, if at all somebody has got the strength, I think all these things will get resolved from tribunal and above. I don't think below tribunal anybody is going to listen to this concept or anything we talk about saying it's revenue neutral. The government has not lost any money and all. I don't think we will succeed. And definitely, I don't think at the adjudication level it will work out. I think it's all tribunal and above.
Got it. Okay. Thank you, Shekhar. Maybe once you update it, let us know so that I'll update it in the group.
Okay, I'll do that.
Okay. And we will move on to the second topic for discussion, which is on the issues in health sector. So Annapurna Srikanth has prepared a case. So we will go by the case wise. Yeah. Of course, Jatin sir had to leave. Yeah. So, yes, Annapurna, over to you. See if you can put up your presentation.
Yeah, one. So, very good morning. I will just share my screen.
Shekhar, maybe you can stop the presentation. Yes. Okay.
Yeah, my screen is visible.
Yes, visible. Yeah. So very good morning, and thank you for this opportunity to take you through this, sector about hospital sector where the GST issues and certain case studies are going to be discussed today. What I'll do is I will run through. One second. Yeah, I will run through the case study which has been shared, and then we will come to the issue specific decision per se. So basically, we have been given with one entity, which although is primarily a hospital, engaged in, providing hospital services, but there are other activities which are associated to this, because practically we see that although by nature it is an hospital entity, but there are so many other services which are also, part of the entire activities which is provided. So there are broad 5 categories of activities which this hospital entity is engaged in. The first is the healthcare services or the multi-specialty hospital services per se. And I have taken one exclusive case study, which is a collaboration arrangement for setting up the birthing centers. So this is more a practical insight. We will dwell with it. Then we have a research division where conduct of research happens on various fronts, and we have the medical college, a typical hospital which would definitely have all of these things. And to add to it, there is also some call center services which is provided by the hospital. Now let us look at the issue specifics to each of the above activities. Now, firstly, as far as this multi-specialty hospital services segment is concerned, which by and large get covered under the healthcare services, there are some issues which have been identified, the taxability of which needs to be examined. The first and foremost, we understand that whenever it is the medicine sales which happens at the pharmacy, there are 2 possibilities: inpatients and outpatients, or even the counter sales for that matter. Whereas for the counter sales, GST is collected and paid. But as far as these inpatient supplies are concerned, what they generally do is they include it as part of the entire billing annexure, where medicine supplied or any other items took up from the pharmacy, generally they are put up at the MRP values, and the patient billing is done including this taxes component, which is part of this MRP pricing. So is this practice primarily correct practice? If not, what are the GST implications going to be? And if at all this need not be this should not be collected. So let's say we arrive at a conclusion that collecting at MRP and not paying taxes is improper. We will discuss on this as we move ahead. If at all, if that is the stand taken, then there is a cost implication on the hospital, because there is, exemption is enemy of GST, which we have heard many times. Jatin sir keeps telling that once there is exemption, the ITC is lost, and because of the loss of this ITC, the costing aspect to the hospital increases. Is there a way this could be recovered, if not by charging the MRP values? So this issue also we will examine. The next aspect would be how to reverse input tax credits, especially from the pharmacy sales per se. What is the right approach to follow, in compliance of this Rule 42? This also we will, take up in a while.
Then we have this occupancy charges, which are collected from these nurses, trainees. Generally they do not collect this from visiting doctors, but from employees and trainees, these occupancy charges are collected. And whether GST is applicable on these occupancy charges is one question to be addressed. Just 1 second. Yeah, sorry. So next issue we have, okay, in this case study, we have also raised one more aspect. Now there is a trust which provides this entire property on lease to this hospital. So, or to this entity per se. So what will be the implications from the trust per se? So this is also one of the things to be examined. The next aspect is room rent for special care services. This is more from the entry 31A in the 11/2017. We will examine this. Is GST applicable because it is a composite supply being part of healthcare services? And of course, it is a no ITC rate. And whether it should be, if at all it should be paid, it should be paid on 1,500 as the differential value or the entire 6,500. These aspects also we will examine. Next, we have the canteen supplies. So as we can see from the case studies, these canteen supplies or the food supplies are made to various people. One to the inpatients, based on the diet and nutrition prescribed by the consulting dietitian. We also have this canteen supplies, probably like the counter sales, where patients and other visitors who come and buy it. We also have canteen supplies at subsidized prices to the trade union members or the the employee union members who get at, the case study says that even at below 80% cost, it is given to them. And for visiting consultants and the doctors, it is given below 20% cost. So when the supplies are made at subsidized prices, what are the implications on this part? Apart from this, the hospital is also engaged in the on-site healthcare services and also this non-cosmetic plastic surgery, the taxability of it, which needs to be examined. Then, like the MRP products which are billed for the patient billing, there are these consumables and implants. Whenever a surgery is undertaken, whatever these implants or the certain other surgical consumables which are being used at the operation theater, which are billed on again including on the MRP basis, and many times these are taken on goods, like the goods taken or approval basis for sale or return. Sometimes it might go beyond 6 months. There is this one aspect also we will examine. So by and large, these are the issues to be discussed as far as the healthcare services is concerned. So let's move to the next aspect of it, the collaboration arrangements with the with an entity for setting up and running of the birthing centers. So the role of the hospital and the role of the collaborator, I'll be discussing a little more in detail when I take up this case study. And there is a slabular system of consideration which has been entered into between the parties. So GST implications on this slabular approach, what could be the underlying service and what is the GST implications. So this also we will discuss. We have the next activity, which is the research division. The GST applicability on the following transactions, paid research services for companies. Now, it could be pharma companies who want some research to be undertaken on certain specific products for which they paid to the entity and get that research services from them. So what would be the implications? Again, we have this funding from certain medical research institutions for specific projects. In fact, we might be very much acquainted with this, where utilization certificates are demanded with many times with the CA certification beyond a limit that this particular fund has been utilized for this particular activity. So there is a clear mandate and an instruction from the institutions who fund these specific projects to be deployed for the very same research projects. So again, we will examine the GST applicability on these things. Then after this research, there is an intellectual property which might come up with. And as can be seen from the case study, this intellectual property basically belongs to those medical research institutions who have paid for who are funding this research, and they get the IP out of it. And later on, there is a possibility that this might be commercially monetized or not. If at all it is commercially monetized, then this entity is also getting a percentage share from the commercial proceeds to the hospital. So these are the various income sources which are coming to the entity through this research division. Then we have this medical college where it conducts, I mean, of course, it is affiliated to the, popular universities, and the revenue implication, I mean, the GST implications to be examined on various courses conducted by it. Few are approved educational courses, few are approved vocational education courses, and it also runs these non-approved vocational courses. And to facilitate the study and conduct of research, or even as a reference for the doctors, it goes for a lot of ebooks subscription, the online ebooks subscription, which will be used by students, doctors, and researchers. Now, whether this would get covered under OIDER, and whether, if it is outside India, then whether RCM will apply on these things, this will be examined. And then we have this housekeeping and security services medical college. This is more to be examined from the inward supply per se section, the entry number 6060, we will come to it. And we have the last activity where, the call center services. It's a 24/7 free call center service to assist callers with mental depression and suicidal tendencies. Now, they don't charge from the people who call them. And there are also, handled by trained employees, supervised by, well-educated human psychologists, the skilled people who handle this. But the funding happens by the CSR initiatives of the various corporates. Now, would GST be applicable for these CSR funds received, with a clear instruction that this fund needs to be deployed for handling this call center per se? So in the light of these various issues, what we would be discussing today, I just wanted to set the pace that this would all be the coverage in today's discussion. Now we will start with the preliminary aspects of this, about the entity. So St. Joseph's Medical and Education Society, Bangalore, it is a society basically, and it is called as a society, but it's a Section 25 company. We understand that, and then it has also obtained a registration under Section 12AA of the Income Tax Act. It has obtained a single GST registration at an entity level. So these are the preliminary aspects about the entity per se. Now, firstly, since we would be discussing about the healthcare segment, I would like to run you through this entry number 74 of 12/2017, which says that the healthcare services, very important to note that there is no blanket exemption per se for the healthcare services, only if such healthcare services are provided by a clinical establishment, an authorized medical practitioner, or paramedics. So the person providing the services should fit into any of these three categories to be able to claim this exemption available under entry number 74. If not, this exemption would not be available. Provided that nothing in this entry shall apply to services provided by a clinical establishment, basically where the room services or the accommodation, or the patient rooms where it is provided, and the room charges exceeding 5,000 per day, to a person receiving the healthcare services. So this is an additional entry which was introduced where except, this is to combat with 31A of 11/2017, where that became taxable and they're excluding that entry from the exemption per se. And of course, there is another entry which says services provided by way of transportation of patients in an ambulance other than those specified in A above. So this is the by and large the entry coverage for exemption as far as this healthcare services is concerned. Now let us understand what is a clinical establishment. So clinical establishment, of course, in the exemption notifications, we have the definitions. As part of the definitions 2S, we have this word clinical establishment being defined. It means a hospital, nursing home, clinic, a sanatorium, or any other institution by whatever name called that offers services or facilities requiring diagnosis or treatment or care for illness, injury, deformity, abnormality, or pregnancy in any recognized systems of medicines in India, or a place established as an independent entity or a part of an establishment to carry out diagnostic or investigative services of diseases. Basically, this covers broadly diagnosis, investigative services, treatment. So these broad three categories, of course, treatment or care. So these categories of services should be provided by the clinical establishment. Even the clinical establishment has to be, the specifics which has been provided here, the hospital, nursing home per se. We also have the, Clinical Establishment Act, wherein, there is a definition given therein as well, which by and large, covers the, what has been adopted in the GST law. I'll just read it for the reference of all of us. As far as that law is concerned, clinical establishment means a hospital, maternity home, nursing home, dispensary, clinic, sanatorium, or an institution by whatever name called that offers services, facilities requiring diagnosis, treatment, or care for illness, injury, deformity, abnormality, or pregnancy in any recognized system of medicine established and administered or maintained by any person or body of persons, whether incorporated or not, or a place established as an independent entity or a part of an establishment referred to in subclause 1 in connection with the diagnosis or treatment of the diseases where pathological, bacteriological, genetic, radiological, chemical, biological investigations or other diagnostic or investigative services with the aid of laboratory or other medical equipment are usually carried on, established and administered or maintained by any person or body of persons, whether incorporated or not, and shall include a clinical establishment owned, controlled, or managed by government. Of course, government, department of government, trust, corporation, local authority, and even a single doctor, but does not include the clinical establishment owned, controlled, or managed by armed forces. So there are some inclusions, exclusions, and so there are some technical aspects of what kind of diagnosis and investigative activity they can take up. So, as far as our GST is concerned, this is a simplified version of that definition. But this becomes very important because even from the second case study, which I would be discussing, who provides this healthcare services is a critical question to be answered as to whether we get this exemption or not. Coming to the next aspect of it, again, this is covered as part of our preliminary discussion. In the case study, it is stated that this entity has obtained 12AA registration under the Income Tax Act. We are aware that entry number 1 of the 12/2017 exempts services provided by an entity registered under 12AA to the extent of charitable activities. I will just read out that specific entry. Yeah. So services by an entity registered under 12AA or 12AB of the income tax by way of charitable activities. Now, charitable activities is not, is again specifically defined in the exemption notification 2R, which means activities relating to 4 different things. I am just limiting the discussion, one to this healthcare industry, another to educational institutions, since both of it has a concern or has relevance to the case studies which we are discussing today. So the first aspect of it, public health by way of care or counseling of terminally ill persons or persons with severe physical or mental disability, persons afflicted with HIV or AIDS, person addicted to a dependence forming substance such as narcotics, drugs, or alcohol, or public awareness of preventive health, family planning, or prevention of HIV infection. As we can make out from this very limited coverage in the charitable activities to the extent of public health is concerned, by and large, most of the activities which the hospital undertake cannot fit under this entry. So, of course, we have the specific entry of 74 itself to cover. We need not visit one. But if at all something do not get covered over there, probably we'll have to think and examine if at all there is a possibility that anything fits in here. By and large, definitely this won't fit over here. So the next part, as far as this education is concerned, advancement of educational programs or skill development relating to abandoned, orphaned, or homeless children, physically or mentally abused and traumatized persons, prisoners, or persons over the age of 65 years residing in rural areas. Again, this would not get covered here. So it might not be of much relevance to take up the entry number 1 for claiming any exemption. So coming back to our issues. Now we will discuss issue by issue. This we have discussed, sale of medicines from pharmacy, at the time of discharge. This is included in the patient's bill. Of course, they don't have, basically, they don't do a separate accounting as far as stock purchase is concerned. This stock is purchased for pharma sales, counter sales, and this stock is purchased for inpatients. Obviously, it is not practical because till the time they make use of it, they will not know the end purpose for which they are buying. So, what is the taxation policy they presently adopt? Over-the-counter sales are taxable and medicines issued to patients are treated as exempt. Now, let us go to the issue per se. So, the hospital is charging medicines to its patients at MRP. The said MRP is fixed under drugs and price control orders issued under the Essential Commodities Act and includes GST. Whether the hospital is required to discharge GST in respect of the price charged to the patients in respect of such medicines. Also, the implants and other consumables used during surgery also are recovered at MRP prices. What should be the ideal practice of billing these items? The hospital wants to know if there is any means by which the tax borne on such purchases could be recovered from the patients. So these are the couple of issues we would be examining now. Now, we understand that MRP being maximum retail selling price under the which is fixed as per this Drugs Control Act. Of course, the Legal Metrology Act requires that nothing should be sold beyond MRP, and MRP is of course inclusive of everything, which means even the taxes. Now, as far as this inpatient billing is concerned, once the recovery for these supplies is made, including taxes, which is the MRP pricing, which means that we have collected taxes and not discharged it, although we are treating it as exempt supply rightly. So the question arises is, what is that we collected and what might be the implication? In my previous discussion in the very same forum, we spoke about Section 76 notices, where anything collected in the name of tax, it need not be tax because there is no levy, there is no tax per se on the exempt supplies because it is a healthcare services getting covered under entry 74. But having said that, once it has become an exempt supply, we are not supposed to collect taxes on that. Now that we have collected something, naming it to be a tax or otherwise, then we are under the duty to pay to the government. Of course, sir, in the previous session, parents patria, the concept which has been brought in by the Mafatlal judgment, where principally the concept says that when there is an undue advantage or if revenue is getting a benefit out of it, it may better get, let revenue itself get it. Instead of unjustly enriching a private party, it is better that revenue gets unjustly enriched. So something principally this parents pater concept works like that. Since there was, Section 76 was introduced keeping all of these previous judgments in mind, where revenue lost cases because although the assessee collected something calling it to be taxes, it could not recover it because levy could not crystallize. Because we have Section 676 under the GST law, tomorrow it is very easy for the revenue to demand, issue a notice under Section 76 and demand this amount as amount collected, treating it to be as tax. And once it is an amount collected, treating it to be as tax, one is not eligible for ITC because it's an exempt supply. Second, if there is already existing balance in the electronic credit ledger, that cannot also be utilized because this is not a tax against which that ITC could be offset. So the implications being, whenever amount is collected in the name of tax at MRP values, that needs to be paid in cash. Now, what is the way out? Yes, Venu sir.
See, when I've collected the prices at MRP, I am only saying that I have, let's say, an implant which is 75,000 rupees MRP. In otherwise, the open market I am selling at 70,000 plus 5,000 GST. But here, I'm just collecting 75,000 and I am not specifically mentioning that the GST is included in it. Would you still say that I have collected GST?
Yeah. See, Section 32 and 33, which clearly says that whenever any amount is collected as tax, it has to be bifurcated. Now, you have not bifurcated out of ignorance or out of not knowing it, whatsoever reason. But
because I have
do
not collected GST.
One second. Do we deny the fact that this is not tax? I will come to the second aspect of how we could recover. How the hospital could recover it, still not calling it as tax.
No, I get your point. But I am saying that, is it right for me to say that if there is no GST in the bill that I have collected GST? As a tax officer, will he be right in saying that?
See, now what is the fact? That is important. Now there could be what gets reflected in the document may not be conclusive of the fact. The underlying fact is that you have collected taxes because you have charged MRP. And MRP is an all-inclusive price. And if you say that you have not collected taxes and taxes are over and above MRP, then you're violating that law, which you don't want to do it, correct?
Yeah, but I am nowhere saying that I have collected GST.
Because you're not saying doesn't mean it is not tax. What disclosure you make will not decide the factual position.
Okay.
So, whenever this tax component is collected, there is this risk at section of notice under Section 76 where it has to be paid in cash. Now, what is the way out? In fact, this is an example which I'm taking out from the SCN book written by Jatin sir, where sir has given a solution as to if at all the hospital wants to make good this loss. Because once I say I cannot collect taxes, there is so much of tax accumulation on account of my purchases. My purchases cost has gone up. My inward supply cost has gone up. So probably if the billing is reorganized in such a way, of course, that it is not merely as a documentation. So the hospital can work backwards and see how much of the ITC cost is going to reduce, to its gross margin or per se, or adding to its cost. And that cost could be recovered in the billing, saying that this is a recovery of the increase in cost owing to this exempt supply. So I think that is one suggestion, one recommendation sir has given, as far as if the hospital is willing to make good this ITC loss, it might as well recover it under a recovery head, arriving at the actual loss of it on an approximation basis. Of course, some working should be there to show that this is actually recovery of ITC lost, because of which this inward supply cost is getting added. So this is something to be considered as far as the billing for the inpatients is concerned. So I'll move to the next issue. Application of Rule 42. I've just reproduced this in a, I'm sure we all, are inclined, very much familiar with this Rule 42, where this, 5 categories of ITC classification is there. I'll just reiterate it for the quick reference purpose and benefit of all of us, where T1 is a credit for non-business purpose, T2 is a credit for fully exempt purpose, and T3 is block credit. T4 is a fully taxable and eligible ITC, and C2 is common credits where it is partly used for business and partly for non-business or exempt supplies per se. Now, as far as this pharmaceuticals is concerned, how does this, how does this Rule 42? One second. So just missed out something typing here. Yeah, sorry. So how to exactly implement and, apply this Rule 42 for the pharmacy sales. Now, as far as pharmacy sales, as we could see from the case study, there is no demarcation at the time of purchase itself as to which stock is for internal usage and which stock is for counter sales. It is impracticable. Now, what is the right approach and what is the wrong approach? Firstly, treating everything as common credits and reversing on proportionate basis of, taxable versus exempt is a wrong approach because it is not common credit. At best, we don't know whether it is a T2 credit or T4 credit at the initial stage. Hence, we have to take a position and then proceed with the corresponding treatment. We have suggested or recommended 2 approaches here. Approach 1, where at the time of purchase for this particular month when we file the returns, we treat everything as T4 credit. So we avail everything in table 4A5 and then reverse as and when inpatient supplies happen. So whenever that credit gets transformed and crystallized as T2 credit, which is fully for exempt supplies, then to that extent we reverse it. Probably, I'm sure technology support helps us a lot. We may have to get a customized report of which are the products which got probably which went into the inpatient billing and which went into the counter sales. If this sale bifurcation is got, probably a corresponding ITC report of how much purchases has suffered the taxes part, if a corresponding report could be generated, this working becomes very easy. But we have to take a stance here and then go with this approach. So approach 2 would be, at the first stage, we will treat everything as a T2 credit, reverse everything and reclaim only to the extent of counter sales, wherein we wait for some credit to get crystallized as a T4 credit and then claim it. I just wanted to have this more as a practical discussion. That's why I'm bringing this aspect. Now, there are risks associated with both the approaches. Probably we'll have to make an assumption or take a position and then proceed with the treatment. What would be the risk at the first approach? The first approach, we are treating everything as eligible at the first instance and only reversing once it gets crystallized as a exempt supplies. Now, this we would have claimed and we might have utilized, and then later on when we reverse after utilization, there is a risk of interest per se. Second approach, when we treat everything at the first instance as a T2 credit and reverse everything and reclaim only to the extent of counter sales, later on, let's say, even after November month, we may reclaim this particular transaction, which earlier we had reversed. Then since the reclaim position is only clear as far as this creditor's aging is concerned and not with respect to other credits, can we avail it? Of course, we have the new amended section 42, which says that after suppliers make the payment, then you can re-avail it. So these are the only two circumstances which are clearly envisaged in the law, whereas as far as reclaim is concerned. In all other cases where we first reverse and then reclaim, of course, I mean, this again could be a subject matter of questioning by the department. So we get the bottom line right. No matter what we do, we can't probably avoid notices per se, but we may have to take a position what suits best in the given circumstances. Probably, if we look at the proportion, we will know whether inpatient billing is more or counter sales is more. Based on the majority, we may take a call of what we want to choose as approach 1 or approach 2. Yes, Venu sir, I see your hand raised.
Okay, so I'm just looking at you are in issue 2. Have you concluded your issue 1 on billing?
Yes.
Okay, what's your suggestion there?
Okay, I'll give an example. Let's say this 100 rupees is an MRP price, which includes, let's say for calculational simplicity, 12 rupees as the taxation part. Now, ideally, because you're falling under an exempt supply, you should have charged your patient 88 rupees and not 100 rupees. Now, because you charge 100 rupees, this 12 rupees is demandable by the department by issuing a notice under 76, which needs to be paid entirely by cash. Now, what is a ideal way out? Probably if we reverse work on this, excluding the margin, my ITC loss might come to, let's say, 9 rupees. So I will recover this 9 rupees as a recovery of cost increase. So this would be a better approach. So I am free to increase my taxable value, but not collect taxes.
So what is the HSN for the 9 rupees which I'm collecting?
It is all
What is
part
the
of
nature?
the
Would it
9993.
be
9993. It is part of healthcare services. Only valuation has increased and no classification change.
no? So let's go back that implant instead of now. I want to sell
Okay.
100 rupees.
Okay.
Okay. Now let's say 88 plus 12 for ease of thing. Now the 12 rupees I'll be collecting as the additional value for the implant. What is the nomenclature I'll say to collect that?
Recovery of cost increase, something like that. You use the nomenclature what best you
Agreed.
think, but it's a
But
recovery. It is increase in my costing which I'm recovering by the customer. You can say that surgery charges itself is reworked considering this.
So would you be putting under section 8 or would you be putting it under 15.2 for the 12 rupees that I'm collecting?
It is definitely part of section 8 read with 15.2 because it is valuation increase. Primary supply is the same. Principal supply doesn't undergo change. I only don't want to collect it, naming it as tax, but recover the actual costing per se.
No, because see, when the patient is in the hospital, at least there is a 5 days, there is a continuous billing that is happening.
Correct.
Now, when the invoice that I'm issuing, let's say for implant separately.
See, probably some technological support has to be taken up. We have to figure out how do we implement, but per se, principally what needs to be done is on the face of the document where the items are being issued, it should not include taxes per se. That could be part of the services billing overall valuation increase. That is fine, but when you name the specific item and collect, including the value, I mean, at the MRP, which includes taxes, then we have an issue.
So the underlying thing is this will not be under 15.2. This would be under 8 as a healthcare service. Per se, this 12 rupees additionally collected is not akin to implant.
Sorry, yeah, please.
Now, what I'm saying is the additional 12 rupees that you're collecting is not akin to implant, but it is part of healthcare service.
See now, even this implants, there is once we give it the broad umbrella of healthcare services, every HSN will also be of that, isn't it? Going by Section 8, all other incidental supplies will take the color and characteristics of principal supply, including the HSN, isn't it? That is why
Correct.
the same rate, same entry, everything. So it is not the question of is it 8 versus 15. First 8, hence 15 follows.
No, okay. Why I'm specifically putting it up is,
Hmm.
see, if it is 8, my position is different. If you say 15,
Hmm.
then the value of implant will become 100. If you are
I'm
saying
not,
8,
I'm not telling about, see, we cannot say the value of implant. Okay, see, okay, now you may even consider your specific implant cost itself increased, but you can't charge margin for that. You got my point, right? Then it will be as good as charging at MRP. Now let's continue the same example what I gave. 100 rupees including okay, like 88 rupees outside. If you're selling it as a product, 88 rupees is the taxable value. 12 is the GST on it. Now you took it for 80 rupees and 12 on it. So which is 92. So there are 8 rupees of margin, just to give an example. So on that margin again, the GST component on that margin has to be removed if you are treating it as recovery of cost. Otherwise, what stance we are taking will lose its meaning.
okay. So if we are assuming this methodology of the billing, so if I go to the issue 2, which you are saying about the common ITC reversal. So assuming I'm going as approach 1, treating everything as T4 and availing, and then reversing when the inpatient supplies happen.
Correct.
When I am doing the reversing at the time when the inpatient supply is happening, I will take the basis as 88.
No, on my purchase, right? Because ITC is on my inward supply. 80 on 80, probably, that 12% whatever comes to some 8 rupees. 8, 9 rupees, whatever it is.
Okay, so at the purchase level itself, you are saying
Yeah.
in
See,
the
correct. This is simple, like as we do for inward supplies. When I purchase whatever ITC is there, to that extent
okay.
of that ITC on my purchases, I will do the reversal per se.
So identifying the respective purchases
Correct.
wouldn't be
So
too tedious and pressure on the system that, okay, which is practically.
Sir, I think, we have to first decide about law, how we are going to, if it is practically difficult to implement, I think there is no point to discuss on it. But in terms of pure law, how else? Can you treat it as common credits, entire thing? It is not, right?
Ideally, I would suggest, like what you said, is approach not to be taken
It's
is
not,
what.
it may be practically easy, but is it right?
I am still unable to convince myself. I'm still feeling that 100 is exempt, so I will use that as a methodology as a top line and reverse it.
See, it is ITC has to be, I mean, for ease of calculations and return filing, given that clients do not substantiate for the value of efforts we put in, generally what is being
I
followed
am
is
keeping that aside. Let us look at what is law.
but principally, don't you think Rule 42 requires this itemized analysis for each item per se? We can't put it in the pool. Maybe by and large, at least to the ledger levels, at least.
I am saying entire medicines is common.
No, I don't think.
So
I mean,
I'm putting each
others in the
item
group
in.
can also give in their thoughts. It cannot be like everything is a common credit. See, what exactly is a common credit? Partly used for taxable and partly used for exempt. Is it not identifiable per se? It is identifiable, but it is difficult to identify is our problem.
No, I will not say difficult to identify because I might have wood lying with me for 3 years also.
Correct.
surgical and other things. So I really don't know whether I'll be using it for taxable or exempt at the time of purchase. So I am saying it is common.
See, just because you cannot identify it at the initial stage doesn't mean it becomes a common credit.
See,
No.
according
Again, it is about taking position.
Okay.
Now, I think the discussion on Rule 42 can be taken separately because that has
Yes.
got a lot of other issues which is connected. We go on
Okay.
to the further issues, okay?
Okay, sir. Okay.
Because these formulas and all only both of you can understand. At least I can't understand.
Sir, other issues will continue next week, sir. It's 9:57. There are many issues.
Yeah, I know. I think Kanpurna, for one of
Yes,
your
sir.
issues, you can also add
Huh.
these colleges. I mean, many of these medical colleges, no?
Yes, sir.
These private institutions do send their students
Huh.
for
Internship. Internship.
whatever they call it as
Huh.
the training. I mean, no utilization fee or a facilitation fee. Because they will not have the facility in their own colleges. Some of the newer medical colleges will not have facilities. So they will get permission for affiliate that to that college, and their students go there, and they medical colleges, especially government colleges, do charge for them for registration. You can just add that if it is not added in your issues.
Okay, sir. I'll do that. So facilitation fees
Or facility or
charged
training charges. Yes, facilitation charges.
charged for providing training facilities to other college students.
It is not exactly training facilities. Maybe the doctors and all they will come, but they do not have the infrastructure and the patients. So
Okay.
Morning, actually, Annapurna, I have sent you a query saying generally they allow
That dead bodies thing, no?
postmortem.
Yeah, yeah.
Yeah.
Okay.
So they
And
allow
I will
other.
include that also. Huh.
yeah, and many a times this will be with affiliation, sometimes without affiliation. Okay.
Okay,
Why
sir.
I'm saying that
Basically,
is
11th question is that
affiliation.
only.
Yeah.
Yes, sir. Okay.
Because why I'm saying that affiliation and non-affiliation, if it is
Hmm.
affiliated, whether the students of the other entity can also be called as a student of
Students.
this
66.
college.
Entry 66. Why
Yeah.
can I be recovered? Okay, sir. Understood, sir. Okay.
Right. Okay. I
Okay,
think
maybe-
And
any other
one aspect is
yeah, please
Yes.
please go ahead, Shekhar. Go ahead, Shekhar.
this is with regard to today, what is happening? We are having something like a co-working space. See, there are few, they call it as a specialty clinics, but they provide the space. Their only duty is to provide the space for the doctors. Doctors come, they give their consultation. If the fees is 500 rupees, he keeps 100 rupees and gives 400 to the doctors as such. So when we look at this scenario, I think maybe you can add that as a thought process or how it could be looked at for the taxability argument. Okay.
I mean, it will be run by a non-clinical establishment. Correct, no?
Yes.
That's your point.
Or basically, there are 2 or 3 scenarios what I can envisage. One is there's a person who is a doctor who runs it. The other one
Correct.
is a person who has a B Pharma or what do you call a medical store they can run,
D-Pharma, yeah.
but D Pharma, and they are running this particular thing, how it is. And if it is by a non-doctor, what happens? Probably.
Yeah, sure. Okay. Probably we can just conclude on this issue, take others' opinion also. Rajesh sir, I understand, how it goes in returns is a different aspect per se, but I would like to request your thoughts on this. Can we treat everything as a common credit in one pool, or is it required to identify transaction-specific categorization of whether it is an eligible credit or it is an ineligible credit, sir?
No, to my understanding, the law cannot insist on a business. If I am not able to identify, because there is if in my business I can design in such a way that I can identify is one. In my business, if I am not able to identify, then obviously it becomes a common. Whether I do have a facility of identifying or not, that's my choice.
Hmm.
Or it is not that compulsorily it is required. Though the law says that used, etc., it is not identifiable as far as I am concerned. Because say one tablet I can administer for both here as
Correct.
well as there. So it is not necessary or a compulsion that I have to maintain a separate stock which goes in over here.
I mean, we need not maintain a stock, sir, but is it not ultimately we know that whether it went here or there? See, it is
No,
not even that
the
earlier
point
it
of
was taxable. Yes, sir.
the point of availing ITC is at the time of receipt, not
Huh.
at the time of consumption. There
Correct.
is no one-to-one correlation. So you cannot insist that at the whatever you have worked, your
Utilization stage.
utilization stage you have to identify, then the entire purpose of the ITC scheme will be defeated, because you cannot hold back the credit between the intervening period of the receipt and the utilization. That is what is my view, taking more clue from the restwhile central excise and service tax regime. Okay.
Okay, sir. Thank you, sir. Other members, you want to add
Yeah.
anything on this? Huh.
Yeah, they can take a feedback from others also.
Yes, sir. Because anyways, we are going to conclude on this point today and continue during the next session.
Madam, on issue number 1,
Huh.
you said that you treat 88 and 12 and pay
Huh.
discharge the 12 rupees in a straightforward manner.
No, no.
Right.
I mean, if at all you're collecting at MRP, then you have to pay this 12 in cash
Correct.
because
So
of the
what if
76.
what if another approach I take and I give discount itself of 12 rupees, saying that I'm not recovering from the MRP?
So
Then
you
I
can say
don't have to
reduction
discount.
reduction to the tax part, reduction of the
Correct.
tax part. But then
Correct.
hospital will be losing that money because ultimately from a business angle, if they see they're losing that money, if at all they want to recover that cost, they can recover it, calling it,
Yeah,
calling it as recovery
hospitals,
cost. And
yeah, hospitals are a little wary about GST authority. So they would say I would prefer not paying GST and still being safe than entering into the GST circle itself.
okay, it's a call or
That's
a
a
position to
possible
be
point.
taken.
Yeah.
Yeah, but
Right.
once we reduce the taxes per se, then yes, absolutely right. We have not collected taxes, exempt supply, it's clear.
Fine. Yeah. And in the
Some
second
hospitals.
issue, just go ahead, Mahila.
No, you finished off.
On the second issue, you are giving the two approaches. Say we go with the first approach and treat everything as taxable, right? Fully taxable. Now, when would be the time limit, or when would you reverse it?
See, like we would have purchased, let's say, 100 items today, this month.
Right.
That might have a lifespan of, let's say, expiry might be 3 years, 4 years. It will stretch over the period. So as and when this, taxability becomes an exempt per se, see, there is crystallization onto whether it is a T4 credit or T2 credit at some future point in time whenever it happens. So.
No, but that point also you are not doing a one-to-one identification. You are doing based on a sales number, right? You are doing it.
No, it has.
But
So, I mean, if at all this approach has to be followed, like, as per my understanding of this provision, this has to be wherever it is possible to identify, it has to be done in this way. If at all, it is a pool where it is a common expenditure which is not identifiable by all our administration, consultation charges, all of those things, then yes, this proportionate turnover approach will apply. But otherwise, it is a specific, like we do
specific
it for the purchase of.
identification method, you're saying.
Yeah.
Okay.
Yes, Mylar, you had something to say.
First one in the approach one. So I agree with you, but my question is only whether interest is applicable. See, whenever I purchase it, I will purchase with the intention to use it for a taxable supply. See, I'll change my intention and I'll use it for exempted. So that there is a change in use. See, because of the change in use, again, you said we need to pay interest. Is it?
No, I didn't say we need to pay interest. I said pay interest. Okay, now initially it is a position that everything we are using it for counter sales. Is that assumption right? We have taken this treatment. We have decided on this treatment because we still don't know whether the end use of whether it is T2, T4 not crystallized at the time of purchase. Correct? No.
Correct.
So now because of this new reporting which says that take everything that comes in 2B, take everything that comes in 2B, put in 4A5, reverse whatever you want to reclaim so that claim conditions are not yet fulfilled.
Correct.
So that in such a case, you will go with approach 2. First, you will claim everything, reverse everything, and reclaim only to the extent of T4. The question comes again is, after November, if you reclaim, tomorrow it can be questioned. Some past credit you are taking. So yes, it is reavailment, but since the position of law is not clear for reclaim, as far as this, other than this creditor aging and other than supplier making payment later on, again, that will come within November of the next year. So only exception is 16 to proviso. So that risk is there. See, however you do, risk is there. Even if you do common credits, tomorrow it could be questioned. There is no.
See, my question is only related to approach 1. Change in use, whether still interest need to be paid, or can we say it's a change in use and later I reverse my credit? Can I escape from the interest? That's the only.
Yeah, probably. See, I think definitely that's a good point we can take, because interest will start ticking only once this position of whether it is an exempt or taxable crystallizes. Correct? No. So definitely we can say Rule 88B is not applicable in this instance. It is not ITC availed and utilized, but the reversal of ITC, the point of reversal of ITC itself arisen at this point in time, hence the interest is not applicable. I think I would also personally recommend approach 1 would be safe to go.
Correct.
Yeah.
Even.
Yeah.
And in respect of issue 1, do you see any issues if the hospital is charging tax even on inpatient billing? See, I see some patients, they'll give the prescription, they ask us to buy it, even in their own pharmacy shop, and they'll charge GST. I think will be
so. In such a case, they have split the services separately. They are not making it as composite supply. That is an independent supply which has to be procured by them. It is not part of the entire composite supply. So they will charge MRP and collect it.
Yeah. Instead of this reversed ITC, collecting the tax and ITC lost, all these things, instead of all these things, this approach will be more simpler and easy for any hospital.
Monitoring and administration. See, if we know the law per se and we agree on these things, if we are aware of it, at the consultation stage, definitely they can get this option to take a call from administration perspective, what is easy for them. So definitely these insights will definitely throw up thoughts like that, how we can, suggest for easier compliance and administration. But yes, at the same time, the value lost because they're not able to recover, that also needs to be considered. Ultimately, even every entity is looked from a business advantage perspective also. Nobody wants to lose on any money per se. Unless there's very much litigation averse and they don't want any of this headache per se.
Yeah, in both the scenario, the loss to the hospital is only GST portion and the profit on medicine.
No. In the first situation, the entire output tax, because entire 12 rupees it has to pay because it has collected that whole money. Anyways, that purchase related ITC.
I'm just comparing your approach where you are collecting ITC, ITC lost from the patient. So in my approach where I'm collecting GST itself, if you calculate the loss to the hospital is nothing but the GST portion and the profit.
Mylar, no. In fact, I mean, maybe we can take up an example. I'm not sure if we are boring all others, but maybe if we are interested, we can do that. So let's say in the situation 1, okay, my costing is, let's say, 80 rupees, and okay, so in the okay, since we took this example throughout, I am just taking this very same example. Let's say approach 1, like most hospitals are doing, they're collecting 100. Now, what is the implication of this? 12 rupees department can demand under section 76. Okay. Now, notice under section 76, to pay this entire 12 rupees in cash. Now, this is the implication. They're collecting this 12, they have to pay it with cash, of course, whenever it has been demanded. The next approach, I will not collect. I will only collect 88. No problem. So then there is no collection of taxes, no payment under 76. Peace. The third approach, what I will do is, I will collect 88, which is my taxable value, plus this 9.6. So I will collect 97.6 instead of 100. This way, I am recovering this 9.6 from the customers, and that is adding to my cash flow. Because it is not tax, there is no question of demand under 76. Clear, no, Myra?
Yeah, clear. So there is no impact on this. Even if you collect 88 plus 12, so your
12 will go off, you will remain with only 88. By using this approach, you will get 97.6. Your loss will be only 0.4, which is GST on the gross margin you have.
Correct. So same thing, GST on the gross margin. Yeah. In both the approach, if I collect 100, that is treating it as a GST portion, that is 88 plus 12, or your approach, the cash flow is same.
Sorry?
See, if the hospital bill it as not as a section 8, it is independently if it is bills. Otherwise, if we collect loss of ITC,
see, now it cannot bill 12, which means that indirectly they're naming it differently. If it has to be cost recovery, it should be proven to be cost recovery. Correct. See, again, we are, if in a perfect situation where department understands all this, I know for taking arguments, we will take all of that. But from pure law perspective, since we are discussing, so if with the minimum loss of 2.4, hospital can be safe.
Yeah, true.
So, Venu sir, shall we conclude for the day? Anybody else has anything to? Venu sir? Venu sir left, huh? Okay. Rajesh sir, anything else, sir, or?
Nothing. We can close.
Yeah, so we'll continue this in the next session. Thank you. Thank you very much, everyone, for your listening. And sure, thank you.